Welcome back, traders and investors, to Fed Friday here on Benzinga's Pre-Market Prep. I'm Joel Elconin along with Dennis Dick with a couple special guests on the line. The first guest is Tom Simpson, former Federal Reserve officer and author of Financial Markets, Banking, and Monetary Policy. Good morning, Tom.
Good morning, Joel and Dennis. Happy New Year.
Also on the line is David Wessel, former Wall Street Journal reporter and director of the Hutchins Center on Fiscal and Monetary Policy. Good morning, David.
Good morning, and Happy New Year to you.
Same. Okay. Well, Tom, we're going to go to you first, and we're talking about the Fed and Federal Reserve policy. Can you just talk about the inner workings of the Fed? What are some of the main factors that guide Federal Reserve policy?
Well, I think one has to start with what the statute specifies in terms of the goals of monetary policy, the so-called dual mandate, which is maximum employment and stable prices. And while that's specified in statute, and some might be skeptical that that's really the agenda of the Fed, in practice it really is. And I think if you look at statements made by Chair Yellen or other Federal Reserve officials, you look at documents that are produced for Congress and the public, things are really organized in terms of achieving those goals, and they spend quite a bit of time explaining how they are going about trying to seek maximum employment and stable prices, which on the latter, they translate into 2% increase in prices per year.
David, I'm going to go to you with this one, and I know you like to work with the public. How much do you think investors really understand fiscal and monetary policy, and how important is it for them to really understand it?
Well, I think the most sophisticated investors, the big ones, understand quite a bit about it. I see a lot of research from Wall Street firms speculating on what the Fed's going to do. Some of it strikes me as nuts, but a lot is pretty sensible, and the same goes for fiscal policy. I think ordinary investors fall into two categories: the people who just buy mutual funds and don't really care much about day-to-day swings, and people who tend to pick stocks or sometimes individual bonds. And I think they underestimate how important the Fed is, and particularly how important fiscal policy is. We saw really in the last couple of years when Congress, in my opinion, was a little bit too tight-fisted with money when the economy was weak. It really did hurt the economy, although it's hard to see that in the stock market.
David, I'm just going to follow up with you here, and you made a point just saying how much investors underestimated. And I mean, if you look just from a stock picking perspective, and when they started QE 4 years ago, if you just blindly came in and said, look, this is going to really drive prices higher, that's exactly what it did. So really, this whole rally over the last 4 or 5 years has really been driven by the Fed, hasn't it?
I think there's a lot to that. Of course, part of the Fed's strategy was to make the economy better by raising asset prices. But the world is always a little more complicated than we think. So when the Fed stopped buying bonds, when quantitative easing came to an end, it was widely expected that that would somehow hurt the markets. After all, the famous Bernanke taper tantrum when he first started talking about ending their purchases was a pretty bad day in the markets. Yet the bond market and the stock market both ended 2014 much higher, even though the Fed stopped putting new monetary adrenaline into the system. But basically, you're right. But I also think that the U.S. stock market, there seems to be some underlying confidence that we're finally out of this thing, and that it reflects also some optimism about the U.S. economy, not just Fed policy.
Tom, I'm going to go to you on this one. So if the QE 4 years ago was a cue to enter the market on the long side, now that QE is trying to be unwound potentially, and we'll get into the impact of 2015, could just be a little sell signal in the markets.
Well, I'm not sure it's a sell signal. I think it suggests that the opportunity for extraordinary gains are pretty limited at this particular point. The market, well, one thing to keep in mind is that the market is fully aware of the Fed The ending, as David pointed out, the ending of QE last fall did not bring about a sell-off in the markets. Markets are forward-looking. They're anticipating that the Fed is going to start to normalize policy. They've built normalization into prices, and so as we go through the year, I don't really expect that there's going to be, in terms of the stock market or even the bond market, that there's going to be a big sell-off. I think another thing to keep in mind is that profits are very strong, and so profits can support the current level of prices. And as long as we don't have a serious disruption in the markets, which could be caused by a surge in inflation or something like that, which is really remote. Apart from that, I think the situation in terms of the equity market is that one can expect decent returns. That one would not expect in the year ahead a major sell-off.
Tom, I just want to follow up. So the Fed has hinted that they're maybe going to raise rates here later this year, coming in 2015. What changes in the economic landscape would force the Fed either to not raise rates or potentially raise them, sooner than expected? So basically, what factors are they looking at here that would change that concern that they could raise rates?
Okay, well, keep in mind the dual mandate, and I think in terms of progress towards maximum employment, we're not there at the point that they regard to be maximum employment, but we're moving in that direction, and things are looking pretty satisfactory in that regard. The other mandate is the stable prices, or what they have translated that into is 2% increase in inflation, and inflation has been steadily running below that. Most recently, in terms of their favored measure, inflation has been 1.4%. So there's a good bit of upward room there for inflation to pick up to get to their target. But I think at this particular point, there may be a little more concern that inflation isn't going to pick up, or maybe even might edge a little bit lower, particularly in light of the plunge in energy prices, oil prices in particular, and the much stronger dollar. I mean, they are going to be holding down not only headline inflation, but they'll for a while be holding down core inflation. And I think if there's not good, solid evidence suggesting that inflation is actually starting to move upwards towards that 2% area, I think there's going to be more of a pause. In terms of the Fed has already indicated that at its most recent meeting, they gave their forecast for what the federal funds rate is going to be at the end of each year through 2017. And the median forecast for the end of this year is a federal funds rate of about 1%. So, where the current level is 0 to 25 basis points. So they fully anticipate to start tightening this year. But my guess is that if inflation, that forecast is conditional on inflation moving upwards somewhat, at least their projection showing that it's going to be rising. And if that doesn't materialize, that will, I'm pretty sure, result in their being more cautious and pausing for a while longer.
David, I want to kind of touch on that same question with you, but I want a little more emphasis, on the impact of the decline in oil. I mean, I don't think anyone anticipated this drop and, the deflationary pressures. Could you just comment on oil and the factors and how that's kind of making the Fed reevaluate their policies?
Yeah, I'm not sure it's going to be as much of a factor as the question implies. I mean, so two things. One is, overall, lower oil prices are great for the U.S. economy. It'll make the U.S. economy stronger than it would have been otherwise. It gives consumers money that they're not spending at the gas station, allows them to spend it at the store, and that spending is more likely to go to U.S. producers than oil is. So that's number one. Number two, in Janet Yellen's last press conference, she talked quite a bit about looking through, I think, the oil price thing. I think they're focused on the underlying rate of inflation, and for years they've told themselves when oil prices go up temporarily, we shouldn't let that make us panic into thinking there's an inflation scare, and I think they'll follow the same logic now. The big difference is that they worry about what's called inflation expectations, what people and investors and consumers and businesses think is going to happen to inflation. And this big drop in oil prices will definitely affect that, and that could add to their anxiety about inflation running less than their 2% target.
David, everybody that holds oil stocks, though, in their 401k gets hit here too. So you can get a savings at the pump, but if you've got significant investments in any oil stocks, doesn't that also hurt you as well?
Oh, yeah. Look, every time there's a big change in prices in the economy, there are winners and losers.
Okay.
On balance, lower oil prices are good for the U.S. economy. If you're in the oil business, maybe even if you're living in Houston, the bad is going to outweigh the good. That's absolutely true. So, I mean, it's always hard to know what do you do with your energy stocks. The right thing to have done was to be sold them 6 months ago, but it doesn't mean the right thing to do is now. That's a much harder call.
Right.
Okay, Thomas, I'm going to go to you on this one, and David, I want you to address it as well, too. I mean, we could talk about Fed policy and what they're going to do and what they're not going to do, but what about the individual investor? You know, how should they approach their portfolio if interest rates begin to rise at some time in 2015?
Okay, well, I'm not sure that an investor would want to alter the composition of a portfolio based on interest rates rising. As I mentioned before, markets are forward-looking, and they have priced in already a certain degree of Fed normalization, policy normalization, which is what they're calling it, which is removing accommodation or raising the federal funds rate, the more simple and direct way of putting it. So I think when that day comes, first of all, the Fed is going to be very transparent, or will try to be very transparent in terms of informing the public about what it intends to do. And particularly if it looks like they are going to be developing a strategy that differs from what's priced into markets, they will try to inform the public. But I don't really see the Fed doing much different than what's already anticipated by the markets, because the Fed has been pretty forthcoming. So this is a long-winded way of saying I don't think it's going to have a big impact. As David pointed out before, the ending of quantitative easing at the end of October of last year did not have an adverse effect on markets. And I think once the Fed starts to raise the federal funds rate, there may be a little bit of disruption to begin with. But I think from the standpoint of the composition, if you've got a good, well thought out strategy and the allocation of your portfolio, I'm not sure this event would, or the possibility that the Fed is going to be tightening in the coming year, would cause you to alter your portfolio composition.
And David, what advice do you have for investors
I'm not quite so confident that this will be smooth. I covered the Federal Reserve in 1994 when they raised interest rates for the first time in a long time. And people at the Fed, very senior officials, they thought they had given all the signals they could possibly give, and it was still very disruptive to the bond market. It contributed to Mexico's economic and financial crisis. It led to the bankruptcy of Orange County, California, because they were kind of on the wrong side of the trade. So my expectation is that there's some surprises lurking out there, and it won't be so smooth. After all, this is really uncharted waters. A rate increase after interest rates have been at zero since 2008 is bound to have some dislocations. I think the place to look, and I noted that Burton Malkiel, the economist from Princeton, had an op-ed in the Wall Street Journal earlier this week, is to worry a little bit about people who are in long-term bond funds. There's every reason to expect that bond funds will have to make a move when Fed raises rates, and if there's a run on those bond funds, if a lot of people take their money out, they might have to sell stuff quickly and stuff. So there's some potential for disruption in investment strategies that do not fully anticipate a change in the interest rate outlook.
Tom, don't you think that the longer the Fed takes to do something or to at least, show which way they're leaning, show their hand a little bit more, don't you think that the longer they wait, the more of a negative immediate impact it's going to have on the stock market?
Well, I think that the longer they wait, to the extent that they are delaying decisions that should be made, and they're just postponing something that should have been done sooner, then I think that's absolutely correct. If the delay owes to inflation not turning up as they're expecting, then I'm not so sure there'll be much of an adverse impact. I think, David points out the 94 episode, and he's absolutely correct. That is something that still is very much in people's minds, including Fed policymakers' minds, because that was a time when, even though, he's absolutely correct, Alan Greenspan tried to signal to the markets in advance that the Fed is going to be tightening. And to some extent, the markets took that into consideration. But as it turned out, the Fed tightened at a much more rapid pace than anybody anticipated, even the Fed, because the economy was a lot stronger and the concern about inflation picking up was much greater. At this particular point in time, the concern is probably more on the side of inflation coming in lower than coming in higher. So I think there are some differences here, but I don't want to throw out the possibility completely that there's going to be an adverse market reaction when this time occurs. But I think, again, if the Fed delays, if, for example, inflation turned out to be not increasing, maybe even edging lower over the coming months, and the Fed postponed its decision until 2016, a year from now. As long as I think it's very forthcoming, as long as the markets understand that the inflation target is something they're taking seriously, then I think once that day arrives, it shouldn't have much of an adverse effect on the markets.
David?
Yeah, can I just weigh in on that? Think about what your implication of the question is, that the Fed should do something now that it thinks will hurt the economy, make it harder for people to get jobs, harder to get raises, in order to avoid some possible financial dislocation later when it raises rates. I just think that the Fed has an obligation to do what it thinks is best for the economy, to keep the markets informed, but not to let the markets and the fear of volatility in the markets lead it to do something that it believes is harmful to the economy. And I think that's what's the discussion that's going on now. And the reason it's complicated is, more complicated than it used to be, is we're all very much aware that financial instability can hurt the regular economy, the real economy. So they have to worry about, are they creating problems for the real economy? But jobs, employment, inflation has to be their first mandate, not is it going to make the markets unhappy.
It's a good point, David. I mean, maybe the Fed has concentrated too much on what the S&P or what the markets are doing overall, and not watching the economy. Tom, what do you have to say to that? Do you think the Fed watches the markets maybe too much nowadays, and they should be just focusing on the economy and ignoring the markets?
Well, I think David is right. I think at the end of the day, it's going to be the economy and the pursuit of the dual mandate, which is going to drive policy, so long as there aren't serious imbalances that are building up. At this point, one can point to a few areas in the markets where there may be some excesses, but reasonable people disagree about these. So I don't think that the condition in the markets is going to be an important influence on Fed decisions for some time to come, unless there is much more evidence that there are excesses that are building up, much more so than are evident at the present time. I think it's important to keep in mind that the Fed this time around is saying that financial stability has the same priority in terms of its policy goals as the standard monetary policy goals, the dual mandate. And so they are going to be keeping a more watchful eye on the financial system, but they're not going to be taking risks here in terms of the economy based on what seems to be rather mixed evidence about excesses in the markets.
Tom, how much can the Fed really raise interest rates here, though? Because we are built on an economy of debt here now. We have been for a number of years. Interest rates have been low forever. Can they really raise rates, like they can raise it a bit, but we can never go back to like 5, 6, 7%, can we? Or we'd really cripple this economy.
Well, I would not expect that. I mean, when we're looking at where might the end point be in terms of interest rates, if everything goes kind of smoothly and we have a smooth liftoff here in terms of policy, and that the Fed has not stoked inflation to be rising above its target, as long as things go fairly smoothly going forward, then we're talking about a federal funds rate that's probably going to be somewhere in the order of 3.5% to 4%. That's where we're going to end up. And if we price other securities in line with that, we're talking about maybe something on the order of 4.5% or a little bit higher in terms of a 10-year Treasury note. So that's where one would expect rates to end up. Now, to the extent that the unexpected happens here and that inflation really starts to pick up and seems to be a threat on the upside, then interest rates could well go higher. We could be talking about a federal funds rate that is back where it was a decade ago, around 5.25%. But I think that the odds at this point are not very high in terms of that kind of outcome.
David, are you comfortable with the notion of QE for the world, basically, overseas? Draghi keeps having it in his back pocket. Do you think that it's going to have an impact on our economy? And also, will QE have the same desired effect in, let's say, Europe that it did on the U.S. economy?
Well, I think the U.S. benefits when the rest of the world pursues economic policies that make their economies healthier. And we are really at a pretty extraordinary period in world economic history where the major economies of the world are struggling with not enough inflation. It's almost hard to believe that we're saying those words. If we were having this conversation in 1980, it would have been inconceivable that would have been a problem. Japan is basically rolling the dice to see if they can get their economy off its back. I think it's showing some early effects, but the problem is that monetary policy is a bridge to something, and it's not clear that Prime Minister Abe is ready to do the structural reforms, the changes to their labor laws and retailing laws and stuff that make their economy less than it could be. I think in Europe the problem is quite different. The monetary union isn't working out as well as they had hoped, but I think Draghi has an obligation to kind of do whatever he can, as he has said, to try and get things going again. The question is whether monetary policy there can do the job. They're much more dependent on banks. They don't have the same capital markets. QE will work differently because there's not one European bond to buy. There's a lot of political resistance to it, which will make people think that they're going to have to be timid, where the Fed was not timid and the Bank of Japan was not timid. So bottom line, yes, I think it's good that they're trying to get their economies going, and monetary policy is an important part of a government's toolkit. And secondly, no, I don't think it's going to work quite as well in Europe as it did here because of all the peculiarities of the Eurozone.
And Tom, QE for the world, is that going to work?
Well, I would, for the most part, concur with David on this. It is working in Japan. This is the second time around in terms of Japan, in terms of large-scale asset purchases. It seemed to have the intended effect the first time around, although they were rather slow in moving into it. But ultimately it seemed to have its effect. So I think it will have a positive effect on Japan. I mean, if you take a look at the yen is pretty weak, and that's going to help Japanese exports, and I'm sure it's already showing through in terms of export performance. I think David is right regarding Europe. There are some real difficult political issues that pertain to asset purchases in Europe, because you're talking about the European Central Bank acquiring sovereign debt, and there's been a lot of division about which sovereign debt they should be acquiring, and particularly now in view of the uncertainties regarding Greece, and that's kind of rekindled concern about the Southern Rim countries and their fiscal positions. There are some real political constraints on the pursuit of quantitative easing by purchasing sovereign debt. So I think it's going to be a little more problematic in Europe, but nonetheless, it's going to have a positive effect on anything they do. Will have a positive effect on giving a little more stimulus to the European economy, which will be good for our economy.
We're on the line with Thomas Simpson, Federal Reserve Officer and author of Financial Markets, Banking, and Monetary Policy, and David Wessel. Gentlemen, before I let you go, one last question for each of you. We're talking about, oil, and we did get into the gold market, but there's always something that the unexpected, like the mortgage crisis in 2008, 2009. There's always something that causes disruption in the markets. Is there something that you guys are kind of keeping in your back of the mind, a fly in the ointment that, could really change things for the U.S. economy and the outlook for interest rates? Tom?
Well, I think we could have a turnaround in oil prices, particularly if the global economy shows a little more strength. And the markets have a tendency to overshoot on the upside and also on the downside. So I think we've got a little more upward scope. I think to a large extent the markets are already pricing in an increase in oil prices. I think the geopolitical situation is something that I would keep my eyes on here. We don't know quite what might be happening in Russia, and the Middle East is always a matter of concern. So I think there can be some surprises on the geopolitical front, which should have adverse effects on global financial markets and the global economy.
And David, anything we should have in our rearview mirror?
Well, I agree that the biggest threats to the U.S. economy come from outside our borders. The one that I'm watching, or two that I'm watching carefully, is can China manage its slowdown without spattering us with all sorts of bad effects? And is there an upswing in extremist political groups in Europe that leads them to run a different policy on both economics and foreign policy and immigration, and that hurts world growth? I think here at home, the upside surprise would be if the new Republicans in Congress and the president could actually make progress on anything. I think that would be such a pleasant surprise that the markets and the voters would celebrate, because their expectations are for 2 more years of gridlock.
Okay, Tom Simpson, former Federal Reserve Officer, and David Wessel, Director of the Hutchins Center on Fiscal and Monetary Policy, joining us here on Benzinga's Pre-Market Prep Fed Friday Forecast. Gentlemen, we cannot thank you enough for your time, and we hope to speak to you soon.
Very good.
You're welcome.
Thank you.
All right,
Thanks,
good day.
guys.